Hello everyone, welcome back to another video lectures. Today we will continue with our chapter 13, and I already mentioned last time in the previous video. So exam 4 we only covered chapter 12 and chapter 13, all right? So we are dropping chapter 15, and the reason because I don't want you guys to cram 3 chapters into 2 weeks, because we only have 2 weeks left of classes. Yeah, and in terms of the homework and the Learn Smart for chapter 15, I'm still deciding, So one idea right now is to ask you guys to do the review problems for exam 4, and I'm gonna give you guys 15 points for the problems. If I'm gonna give you grade for the problems, to replace the grade, yes, that you're supposed to have for chapter 15. Uh, so yeah, so that's currently one idea right now that I'm having, and yeah, maybe we're gonna go with that. Um, all right, so let's get back to our lectures. So last time we stopped here. So remember last time in the previous video we already talked about several several types of book tax differences, right? We talk about what is book tax differences, what is permanent, what is temporary differences, what is favorable, and what is unfavorable tax differences, right? Book tax differences. So in today's videos, we're going to talk about some of the important item related to book tax differences, all right? So we will start off with stock option, So the treatment for stock option for book purpose and for tax purpose is different, right? So and in order to make it easier for me to explain, I already draw this chart. So remember, I think in chapter, I don't quite remember what chapter 8, I think, or chapter 7. Anyway, so we already talked a little bit about like how does a stock option works, right? So basically, stock option is a way that um, corporation can compensate their key employees, right? So a stock option allow the option holders to buy the stocks of a company at a predetermined price, and if the predetermined price is lower than the market value, the market price of the stock, then the holders of the option, the one who have the option, can exercise the option to buy the stock for cheap, right? And then whether or not they want to hold it or want to resell it for a profit, and that up to the option holders, right? So basically, for stock option, there are several important dates that we have to remember, right? So that's the grant date, right? Because basically, this is the date when the companies issued the option to the employee, right? Um, and then the employee usually have to wait for a period of time until the option is fully vested, right? So the fully vested means the options, the holders of the options can now um, have the ability to exercise the option, right? Uh, so that way, from the granted to the vested date, it depends on the companies. It can be 1 year, it can be 2 years, it can be many years. And the reason they have such a long period of time, vesting time, not what they call, basically it's a waiting time, right? Is to keep the employee to continue to work with the firm, to motivate the company, the employee to work with the firm, right? So in that way, the employee have to work for the firm for the whole amount of for the whole period of a vesting period, right? In order for them to exercise the stock option, right? Otherwise, they cannot exercise the option, right? So after the option is fully vested, then if the the shareholder, the employees, right, the holders of the option, if they decide to exercise the options, then they can exercise and they can go out and buy the stock for the predetermined price. So the as we already mentioned from last time, on the day of the exercise date, right, if the market value, the market price of the stock is higher than the exercise price, then the difference between the two prices is going to be the bargain element, right? Remember? So because on the exercise date, the employee, right, the holders of the options can buy the stock for cheap, right, for the predetermined price, right? Say the option allow them to buy a stock at $3, right? And then on the exercise date, the market value of the stock is $10, right? So the difference between $10 and $3 is going to be the bargain element. So we have the bargain element of $7, right? So we already talked about in the previous chapters, right? So I just want to remind you ourselves, about how the options work, right? So what is the differences between book and tax, um, regarding to stock option, right? So again, depending on the types of option, right? So we know there's two main types of option: the incentive stock option and the non-qualified stock options, right? So for book purposes, for both of the types of option, the companies have to record the fair market value, the basically the compensation expense for granting the employee the options, right? So and the amount that they're going to record for the expense is going to be the fair market value of the options, you know. So the option itself has some value, right? It is the right to buy the stock for a certain price, right? So the option itself has the fair market value to it, right? So the for book purpose, corporation have to record the fair market value of the options that are given to the employee as the compensation they give to the employees, right? So for book purpose, they have to record the fair market value of the options, right? And then what about for tax purpose, right? So for the incentive stock options, there's nothing to be done for tax purpose, right? Because the incentive stock options, the corporation cannot deduct anything um, for tax purpose, right? So there's no deduction for incentive stock options, right? But for the non-qualified stock options, right? So on the exercise date, right, the corporation can deduct the bargain elements, right? So because of these differences, right, between the two, so we know that now we know for incentive stock options, that's going to be a um, permanent unfavorable book tax difference, right? Because for book purpose, the corporation can still deduct the fair market value of the option, right? But for tax purpose, there's no deduction that the company can do, right? But for non-qualified stock options, um, it's going to be um, part of it's going to be temporary and part of it's going to be permanent differences, right? So um, if the if the bargain elements, um, let's say if the bargain element is exactly the same as the fair market value of the options, right? Let's say right that's right. So now what we have here is going to be a temporary differences, right? Because you record a book differences here on the grant date. You record a book. You record for book purpose the expense here, right, on the grant date. So this is going to be on the grant date. This transaction risk record is going to be unfavorable, temporary unfavorable book tax difference, right? And then on the exercise date, if the bargain element is exactly the same as the fair market value of the option here, then the difference is going to be reversed, right? So now it's going to be a favorable book tax difference here, right? But if the bargain elements here is larger than the fair market value of the option, right? So here I put y greater than x here. Then there's going to be a favorable differences right? And it's going to be a permanent favorable differences between these two, right? Because here, if this amount is larger than this amount, right? So for tax purpose, that means the firm can deduct more, right? So it's going to create a favorable differences, right? And then vice versa, if this bargain element is smaller than this fair market value of the options, right? Then it's going to create an unfavorable differences, an unfavorable difference, right? Because now for tax purpose, the firm can only deduct um, less than when they can less than what they can deduct for book purpose, right? So yeah, so I hope these figures create is help you guys a little bit into understanding um, these problems, you know. So let's look at um, let's look at the example right here, right? So I hope this example can clarify what I just said. Right. So let's see. So we say assume that on December 31st, 2018, CCS, right, the corporation, issued 1,000 incentive stock options, ISOs, right, to Nicole, and the option were valued at $6 each, right. So the option itself has a value to it, right, and each of it was $6, and was scheduled to vest on December 31st, 2019, right. So the vesting period is 1 year. So each option entitled Nicole to purchase one share of CCS stock for $15 a share. Right? So this is going to be the exercise price, right? She can buy the stock for $15 per share. Yeah. And then Nicole exercised option in 2019 when they vested, and the CCS stock was valued at $22 per share on the date of exercise. So the market price of the stock is $22 on the exercise date, right? So the bargain element here, we're going to have a $7 a share, a bargain element. Right? So for book purpose, CCS reported compensation expense in 2019 from the incentive stock option in the amount of $6,000, right? Because $6 times 1,000 share, right? So $6,000. So and this is going to be the fair market value of the stock options that they recorded in the book, right? On the day that they granted, on the day that the corporation grant the options to the employees, right? So the question asks, what would be CCS 2019 book tax difference associated with the incentive stock options? Would the difference be favorable or unfavorable? Would the difference be permanent or temporary? Right. So because this is a ISO, right? This is the incentive stock option, right? So let's go back to here. Right. So we know that on this date, right, on the grant date, the company recorded an expense of $6,000, right? $6,000, right? $6,000. Um, and then the bargain element on the side is $7 a share, and times 1,000 is going to be $7,000. Right? However, because this is an incentive stock option, right, we don't record anything for tax purposes. There's no deduction for tax purpose for incentive stock options. So that's why in this situation we're going to have a $6,000 book tax difference, right? And since for tax purpose the company cannot deduct anything, so it's going to be an unfavorable book tax difference. Right? And then um, because there's no way this can be reversed in the future, right? So it's going to be a permanent differences. Right? So let's look at the answer. So $6,000 unfavorable permanent differences because we can deduct $6,000 for books, but $0 for tax. All right. So let's look at the second example. So this is going to be a non-qualified stock option. Right. So we say assume that on December 31st, 2018, CCS issued 1,000 non-qualified options to Nicole, and the options were valued at $6 each and was scheduled to vest on December 31st, 2019. Each option is the Nicole to purchase one share for $15. So everything is like last example, right? And then The exercise on the exercise date, the market price of the CCS stock is $22. For book purposes, CCS reported the compensation expense in 2019 from the option in the amount of $6,000. Right. So the question asks, what would be CCS 2019 book tax difference associated with the non-qualified options? Would the difference be favorable or unfavorable? And would the difference be permanent or temporary? Right. So in this case, right, it is non-qualified option, right? So we know um, the firm gonna record $6,000 here in the word, right, for book purpose, right, for book purpose. And then on the exercise date, now since it is non-qualified option, right, the firm had to deduct, the firm can deduct, right, the bargain elements, which is gonna be 22 subtract 15, $7 times 1,000, right? It's gonna be $7,000, right? $7,000. Right. So now on after the exercise date, right, there's going to be a $1,000 difference between book and tax, right? And this is $1,000 going to be a permanent favorable difference, right? So let's look at the answer, right? So we're going to have a $1,000 favorable permanent book tax difference, right? And the tax deduction because the tax deduction for the options is $7,000 of bargain elements, right? We have right here, right, bargain elements. And then the book deduction is only $6,000, right? So like the previous example, $6,000, right? So the difference between these two now is going to be $1,000, right? And that's going to be permanent. All right. So yeah, so that um, I hope that this two example help you guys understand why why there's a book tax difference in the treatment for stock options, you know. So the goal for today's class is to introduce you guys to some of the major book tax differences items, you know, and kind of give you an idea how it works and why there's such differences, right? All right, so that was stock options. Let's talk about net capital losses. All right, so net capital losses occur when the company usually when the company sell capital assets, right, and then if they incur a loss, then they may deduct the loss, right? So currently for corporation, company can only deduct net capital loss to the extent of capital gains. You know, so if let's say they sell a bunch of capital assets, and on some transaction they have a gain, capital gain, right? Some transaction they have capital losses. So um, the if the losses amount is larger than the gains, then the company can only deduct the losses to the extent of the gain, right? And then the leftover they can carry forward for 5 years, right? Or can carry back for 3 years, right? And yeah, so if there's a net capital loss, right, they can do that. Um, and then for the year for the year that they incur the net capital loss, rate, it's going to create an unfavorable temporary book tax difference, right? Because they cannot deduct the net capital loss, the leftover net capital loss, right? Because they can only the company can only deduct capital loss to the extent of capital gain. Right? So the net capital loss cannot be deducted in the year that the loss occurred, right? But because it can carry over, it can carry forward, so this difference is going to be reversed in either in the futures or you can say in the past, right? So that's why it's temporary, right? And so for the year of when the net loss happened, it is unfavorable, right? But um, when the net capital loss can be carried over or carry forward, that is going to create a favorable book tax differences, right? So Yeah, so that was net capital loss. And then let's talk about net operating loss. So what happened to net operating loss? So net operating loss, remember the difference between this and net capital loss is that net capital loss happen when, say, when you sell the capital assets, right? But net operating loss is a loss incurred um, for your, let's say, your ordinary activities, right? The main, the main operation, the main operation of the corporation, right? So, um, so for net operating losses, if there's a loss, right, the firm can the firm cannot deduct, similar to negative loss. Net operating, if the company has a net operating loss, they cannot really deduct um, for the current year, that the year that they have the loss, right? But the loss can be carried forward, right? So before 2018, if the firm had a net operating loss, then if the net operating loss happened before 2018, let's just say that, right? Then the company can carry back the net operating loss for 2 years, then carry forward the net operating loss for 100%, right? For 20 years, and then for up to 100% of taxable income for those years, right? So basically, if let's say in 2017, a corporation has a net operating loss of $1 million, right? And in 2018, the corporation has a net income of let's say $1 million as well, right? So last year, in 2017, the firm had net loss of 1 million, and in 2018, the firm has the net income of $1 million, right? So what we can do is we can carry over the net operating loss from 2017 to offset 100% of the net income in 2018, right? So in 2018, in this case, the income is going to go to it's going to be offset out, and it's going to be come zero, right? So the firm don't have to pay any tax on that, right? Um, so yeah, so that was for net operating loss that happens before 2018, right? But after the tax law changes, the net operating loss that occurs after 2017, so starting 2018, the net operating loss can be carried forward indefinitely. So before it's only 20 years, but now net operating loss can be carried indefinitely, carried forward indefinitely, right? However, they can only offset up to 80% of the taxable income, right? So back to our example, now let's say if in 2018 the firm had a net loss of $1 million, and in 2019 the firm has the net income of $1 million, right? So now in 2019, the firm can only use 80% of the loss, right? Can only use a loss to offset 80% of the income in 2019, right? So we have $1 million of income in 2019. So we can offset only $800,000, right? And we still have to report $200,000 of income for 2019, right? So, and then for the net operating loss that occurs after 2017, the company cannot carry back, right? Before it was company can carry back 2 years, right? But now for net operating loss occurs after 2018, they cannot carry back, right? Can only carry forward, but can carry forward indefinitely. All right. And in the case when the corporation have multiple net operating loss carryovers, because they maybe multiple years in the past they have losses, right? So what they can do is they can still use all of them to offset, right? But they have to use they have to offset the net operating loss following in order, right? So you have to use the oldest first, right? The oldest net operating loss first, right? So let's say if the firm has a net operating loss in 2017 and 2018 and have a net income in 2019, then the firm has to use the net operating loss in 2017 first, and then if they still have some income and they still able to offset income, they still have room to offset the income, then they can start to using the 2018 net operating loss, right? So yeah, so let's look at an example, right? So the question says, the problem says, CCS, right, the corporation reported a net operating loss of $50,000 for 2019, and it carried the loss forward to 2020, right? And before the net of loss deduction, CCS reported taxable income of $40,000 in 2020. What is CCS taxable income in 2020 after the net operating loss deduction? So you can see here the loss happens, right? The loss occurs after 2017, in 2019, right? So what does that mean? It means that this net operating loss can carry forward indefinitely, right? And however, it can only offset 80% of the taxable income, right? So in this case, the taxable income of 2020 is $40,000, but only 80% of the $40,000 can be offset by using the losses from 2019, right? So 80% of $40,000 is $32,000. So the firm can offset $32,000, and the firm can still need to report $8,000 of net operating of taxable income, right? So the question is $8,000, right? They still have to report $8,000 of taxable income, right? And then still after deduct the income in 2020, the firm still have leftover $18,000 of net operating loss that hasn't been used, right? So they can still carry over the $18,000 indefinitely, right? All right, so that was net operating loss. So let's talk about charitable contributions. Um, for charitable contributions, oh, let me go back to the net operating loss a bit. So for both net operating loss and net capital loss rate, what is the reason why there's a book tax difference in these items? Well, the reason is that for both net capital loss and net operating loss rate, the firm cannot deduct the loss in the year that the loss occurred, right? For tax purpose, right? But for book purpose, a firm can easily report a loss, right? So let's say the firm have a loss of $1 million, right? They can report for the book purpose that they have the loss of $1 million, right? But for tax purpose, they cannot deduct $1 million in the year that the loss occurred, right? So in the current year, they cannot do anything for tax purpose, right? They don't have to pay tax, but they cannot claim that $1 million for tax purpose, right? To require the government to reimburse them, right? But in the futures, they can use that loss to offset um, the income in the future. Right? So for the year that the loss occur, right? It's going to create a unfavorable book tax, unfavorable temporary book tax differences, right? But for the year that the firm can use the carry over net operating loss to offset the income, then at that time it's going to create favorable temporary book tax differences, right? It's going to reverse. Right? So yeah, so I just wanted to mention that. So let's talk about charitable contribution, right? So so for charitable contribution, the amount of deduction for tax corporation, the amount of tax deductions that corporation usually can deduct is varied based on the types of the asset of the contributed asset. So if the capital gain, if the contributed asset is capital gain properties, then the firm can use fair market value of the asset to deduct for tax purpose, right? But if the contributed asset is an ordinary income properties, then the corporation can only use the adjusted basis of the contributed assets to deduct, right, for tax purpose, right. For and then if the corporation donated cash, then they just report the same amount for the same amount of cash, right. So that's for tax purpose. For book purpose, the firm can just report. Um, it doesn't matter the regarding the type of the asset where the firm can just report. Right? So, but for tax purpose, the amount report vary from the types of the asset. So that's why there may be differences, um, right, in terms of between book and tax record, right. So and then for when firms use accrue methods, you know, um, which I mean most corporations use accrued method, right? The firm can deduct the the firm can deduct the, uh, the contributed the donated amount, right, when the amount is approved by the board of directors before the year end. Right? So basically, if this year the board meet and they agreed, okay, the corporation can say donate to a qualified organizations next year, so even though they not going to reimburse, they're not going to give the money to the organization until next year, but since the board approved the plan this year, then they can the firm can still deduct the amount for they deduct the amount this year, right? And but the requirement for this is that the amount it has to be paid within 3.5 years after the end of the year, right? After they approve, they have to be paid out to the organization within 3.5 months, right? After the three and 3.5 months, right? After the year end of the year end of the year that the board approved, right? So if the board met and they approved that, okay, next year the company can donate money to a qualified organizations, right? And then the tax year, the year end of this corporation is the December 31st, right? So by March 15, no, by April 15 of the year of next year, right? The firm has to give the organizations the money that they agree upon, right? So that's charitable contributions. And what else? Oh, and then remember we talked about this, right? There's some limitations for the amount of charitable contribution that you can deduct, right? So usually the deduction of charitable contribution can only be limited to 10% of the taxable income before deducting this item, right? So any charitable contribution, the dividend received deduction and capital loss carry back, right? And remember, it's carry back, not carry over, right? So um, so this is why this is another reason why there can be book tax preferences, right? Because there's a limitation on the deduction for the tax purpose, right? But for book purpose, the firm can always record the expense for the full whole amount, right? For the full amount. But for tax purpose, the amount can be limited by the deduction limitation right here, right? So this is another time um, when book tax difference can arise, right? Before considering the charitable contribution limitation was $40,000, right? So that you donate $40,000. No, no, no. The income of the company is $40,000, right? The 2019 taxable income before they donated the charitable contribution limitation was $40,000. And then the taxable income computation includes $5,000 of charitable contribution deduction, $1,000 of dividend reduced deductions, right? Um, is that what? Yeah, dividend received deduction. Sorry, not reduced. Dividend received deductions, right? And $2,000 of net capital loss carryover deductions, right? And $12,000 of deduction depreciations, right? And then it asks under these circumstances, what would be CCS 2019 deductible charitable contributions? What would be its charitable contribution carryover? And what would be when would the carryover expire? Right. So let's get back here, right? So we know the limitation applied to 10% of taxable income before deducting any charitable contribution, the dividends received deduction, and capital loss carrybacks, right? And then the excess contributions, the remaining contributions that are not deductible, can be carried forward for up to 5 years, right? So based on this information, you can solve this, right? So let's look at this. Right, so we start with the taxable income before any considering the limitation, right, which is $40,000, right? And then we had to add back the charitable contribution, right? Because this $40,000 already includes the $5,000 of charitable contribution deduction, right? So we have to add it back, had to add back the $5,000, and then we also had to add back the $1,000 of dividend received deduction, right? And what else? And we have $2,000 of net capital loss carry over, right? But since we only need to make adjustment to capital loss carrybacks, right? So carryovers, capital loss, we don't have to worry about, right? So we don't have any capital. We don't have to do anything with the capital loss here, right? So then we have the charitable contribution limit modified taxable income, $46,000, and this $46,000 is going to be used to apply the 10%. All right. So we apply the 10%, and we have the charitable contribution deduction limit, which is 4,600, 10% of $46,000. All right. And so the firm deduct $5,000, right? But they can only deduct $4,600 for tax purposes, and then they have $400 remaining, which can be carried forward for up to 5 years. All right. So, all right. And well, it's going to expire in 2024, right? Because that 5 years after 2019. Right. So that was charitable contribution, right? So again, the main book tax differences for charitable contribution, I would say, is kind of generated from this deduction limitation, right? Because for book purpose, the firm, like in this case, the firm can deduct the whole $5,000, right? But for book purpose, because of the limitation, they can only deduct 4,600, right? So here's going to create a book tax difference right here. Right? However, this book tax difference can be reversible in the futures, right? Because in the futures, the firm can still apply the remaining $400 here, right, to offset the taxable income. All right. So on the year that the firm donate the money, right, it's likely that there's going to be a temporary unfavorable book tax difference happens, right? So yeah, so that was charitable contributions. Next, let's talk about dividends received deduction, right? So we just talked about this in, I believe, in the previous chapters, right? So this dividend received deduction program is designed to reduce um, reduce the extent of triple taxation, right? We have double taxation, but then we have triple taxation, and triple taxation happens when the shareholder of a corporation is also a corporation, right? So now when corporation A, let's say corporation A own corporation B, right? So then when corporation B start distributing dividends, then first corporation B need to pay tax at the corporate level, right? And then whatever left over, then they can distribute out to shareholders, including corporation A, right? And then corporation A, after they receive the dividend from corporation B, they also have to pay tax on the corporate level, right? Before distributing out the money, the dividend to their own shareholders, right? So that's the second level, and then the shareholders of corporation A, after receive the dividend distribute out from the company from corporation A, they have to pay tax on at the individual personal level as well, right? So that's the third level, right? So that's triple taxation. So again, we already talked about this in previous chapters, so I'm not gonna talk much about it anymore. But yeah, so remember the DRD, right? The dividend received deductions is only applied for tax deduction. It doesn't apply for book purpose, right? So for DRD, since it's strictly applied to tax deduction, that's why it's going to create a permanent book tax difference, right? Because it only applies to tax deduction. It doesn't apply to book deductions. All right. So we already learned from last time the percentage of dividend received deduction, right? So if the corporation, right, say if corporation A own less than 20% of corporation B, right, then corporation A can exclude 50% of the dividends they receive from corporation B, right, and is only pay tax on the 50%, right. If if corporation A owns at least 20%, but less than 80%, so anywhere between 20% and 80% of corporation B, then corporation A can exclude 65% of the dividend they receive from corporation B, right? So only pay tax on 35% of the dividend that corporation A received from the corporation B, right? And then if corporation A own more than 80% of corporation B, then corporation A can exclude 100% of the dividend they receive from corporation B, right? Meaning they don't have to pay tax on the dividend that they receive from corporation B. All right. So again, all of this we already mentioned in the previous chapters, right? This is just a review. Right? So that's a limitation on this, right? So we know deduction, right? The deduction is limited to the lesser of dividends times the DID percentage rate, or the DID modified taxable income times the DID percentage, right? So DID percentage is this amount, right? 50%, 65%, 100%, right? Um, and the limitation apply to the lesser of these two, right? Of dividend times DID percentage, or DRD modified taxable income times DID percentage. So yeah, so um, let's look at one of the example here. Let's see, right? So this example, it says, suppose that CCS, right, the corporation received a $3,000 dividend from IBM, and that CCS owns less than 1% of IBM stock, right? So now we know the DRD percentage is going to be 50%, right? Because CCS owns less than 1% of IBM stock. And let's further assume that CCS taxable income before the dividend received deduction was only $5,000. Was $5,000 in scenario A and $1,500 in scenario B. So they choose scenarios A and B, right? So to arrive at the taxable under both scenario before DID, CCS deducted $1,000 of net operating loss carryover, and CCS dividend received deduction associated with the dividend scenario A. And what is CCS dividend received deduction associated with dividend in scenario A and scenario B, right? So first of all, I forgot to mention, right, the DRD modified taxable income. The way we calculate it is to take the taxable income, and then we have to make the adjustment for DRD, right, for net of loss, and then for capital loss carrybacks. So basically, it's the same way we calculate the modified taxable income for charitable contributions, right? So in this case, we know the taxable before dividend receipt deduction, right, was $5,000 for scenario A. Let's talk about scenario A first, right? So it was $5,000, and then we know there's a carry net of loss carry over, right? Net of loss carry over of $1,000 or $1,000, right? So we have to add that back, right? So we have to add that back. So now that's the only thing that we have to add back. There's no other item. There's no capital loss carry back or um, DID, right? So this before DID, right? So $1,000. So we have DID modified taxable income of $6,000, right? And then we know that the dividend income is $3,000. So because CCS own less than 20%, so the DRD percentage is 50%, right? So we take $3,000 times 50%, which comes to $1,500, right? All right, and then right, so that's why we have 1,500 here, because 1,500 is smaller than $3,000, right? All right, so that's scenario A. Let's look at scenario B, right? So in scenario B, the taxable income before anything, before any dividends receipt deduction was $1,500, right? So again, we also have to add back the net of loss carry over of $1,000, right? So we have the DRD modified taxable income now is $2,500, right? And then we have the dividend income is $3,000. So first we calculate the 50% of the dividend income, right? And that gives us $1,500. And then we also have to calculate the 50% of the DRD modified taxable income rate, which is 50% of 2,500, and that gives us 1,250, right? So now because 1,250 is smaller than 1,500 here, so now we have to use 1,250 as a deductible DRD, right? So yeah, so this 1,500 and 1,250 right here, this is going to be the amount of book tax difference, right? And this book tax difference is going to be a permanent book tax difference because the DRD program only apply to tax purpose, to tax deduction. This doesn't apply to book deductions. So that's why this two amount right here is only going to appear um, in the book, no, in the tax system, right? In the tax deduction, right? And it's not going to appear. It's not going to show up in the book. All right. So that was DRD. Right? So yeah. So what we just talk about, right? We talk about charitable contribution. We talk about dividend receipt deduction. We talk about stock options. We talk about capital loss, net capital loss. We have to talk about net operating losses, right? So these are some of the major book tax differences items that you usually see, right? And then we talk about why there's book tax differences, right? So yeah, so again, I think you're gonna study much deeper about all of this concept in the next tax class, in corporate tax. So the goal for me right here is to introduce to you guys the book tax differences, and why there's book tax differences. So hopefully this is going to help you um, in the future, when you take the corporate tax class. All right. So all right. So let's move on. Right. So we don't have much left. So tax liabilities, right? So for corporate tax, it's a flat rate tax, right? As of right now, it's 21%, right? And it doesn't really matter. Um, unlike individual taxation, we have ordinary tax rate and we have capital long-term capital tax rate, right? For corporate tax, everything is taxed at 21%, right? So let's say one corporation receive a dividend from another corporation, right? So if it was an individual, then we can use the preferential tax schedule, right? Tax rate to calculate the tax liabilities, right? But for corporate tax, we're just going to use the same 21% to calculate the tax on the qualified dividend that they receive from another corporations, right? So that's not much to talk about, just remember the tax rate right now is 21%, but well, even in the futures, if there's any tax law change, then this is going to change. This used to be, I think, this used to be 35%, I think, a few years ago. But after the new tax law changes, it's bring down to 21%. Right. So let's talk about compliances, right? So, and again, all of this, I think, here I just wanted to mention a few things, but um, the technicality of it, I think, is going to be covered in a corporate tax class, right? So a corporation report taxable income on Form 1120, and depending on the size of the corporation, the firm had to attach some more other schedule, and one of the the most important schedule is the schedule M, and I will show you right here, right? So basically, this schedule M, right? So depending on the size of the firm, is going to be either, if it's small firm, they can use schedule M1. If big firms, they can use schedule M3, right? So the M schedules are put where firms report the book tax differences, um, to reconcile the book accounting and the tax accounting, right? So that's why it's important, right? So all corporations have to file this form, right? So remember that, right? And what about the tax return due date for corporation, right? So we already mentioned this probably at the beginning of the semester, right? So for corporation, the return are due 3.5 months after the close of the tax year, right? And but for June 30th year-end corporation, the due date is only 2.5 months, right? And then all corporation going to receive automatically 5-month extension for filing, um, so, and then if they file for June 30th year end, then they can have an automatic 6-month extension, right? So yeah, and then what happens when it comes to a conglomerate company, conglomerate corporation, when one corporation own a lot of other subsidiaries, so if there's such a firm, if you have to do tax for such corporation, right? What they call here is affiliated groups, right? So affiliated groups happens when one big corporation own more than 80% of the other corporation, right? So if that was the scenario, then you have to file one consolidated tax returns for the big corporation, right? For the mother corporation, let's say that, yeah, right? And you have to treat all of the groups as one entities, right? I remember I used to work I used to work in the tax department for a bank before, our West Bank, um, and that bank, they own a lot of smaller subsidiaries. They have a title company, they have a, a finance company. They have like 10 subsidiaries. So I remember I had to prepare tax for each of the subsidiary of the company, and then um, our group have to finally, like, near September, September 15. That's when the due date, right? After the extension, and we have to prepare the return, like, consolidate everything together, and then prepare the one big return for the mother corporation, right? So right, let's talk about estimate payments, right? So similar to individual taxpayers, right? I mean, we also have to estimate payment, right? And every month when we receive our paycheck, like the employer take out withhold the tax that the estimated tax that we're supposed to pay, right? So same thing for corporation, but for corporation, there are only 4 installments, right? So the installment due date is going to be the 15th day of the 4th month, the 6th month, the 9th month, and the 12th month, right? Basically corresponding to the quarter of operation, right? So the the corporation must fulfill the uh, required must prepaid the required uh, annual payment rate. So which is the lowest of the following items, right? So either 100% of the tax liabilities on prior year return, right, or 100% of the current year tax liabilities, or 100% of the estimated current year tax liabilities using annualized methods, right? So it's going to be the lowest of these 3 items, right? So the firm has to make sure that they paid they fulfill this one of these 3, right? The lowest of one of these 3, right? Otherwise, they're going to be subjected to underpayment penalty, right? Which is it can be costly, right? Um, yeah, and yeah, so I think that's probably the end. Yeah, that's probably the end of chapter 13. Other stuff are just not really relevant. So yeah, so for now we already finished chapter 13, and that's it. Congratulations, you finished this course. You know, or, well, not finished. You finished the material of this course, right? And we still have the exam 4 waiting for us, right? So, but yeah, so after today, I'm gonna see. I will try to see what I want to test you guys on, and I'm gonna create a review video for all of you. And yeah, and then remember we drop chapter 15, right? So I think yeah, so I think what I have in mind right now is to ask you guys to complete the problems in the review notes, right? And then I'm gonna give you 15 points if you finish that, you know, to replace the assignment the homework grade for chapter 15, right? Because chapter 15 we dropped chapter 15, right? So um, right, so I think that's the plan, right? So all right, so I see you in the next video, right? Which is the review session, right? Take care.